Welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmian, and next to me here in the studio is my friend Niklas Savos. How are you doing today?
I'm really good. Spring is approaching, sun is shining, and we have a really interesting guest today.
I agree. Today we're talking with Oddbjørn Dybvad, Investment Director and Portfolio Manager of REQ Global Compounders. He is also the author of Investing in Value Creators, Time-Tested Principles for Long-Term Stock Investments. Why have we chosen this book?
To me, what really stands out with this book is Oddbjørn's innovative conclusions from his long experience as a money manager. He also illustrates his thoughts very well through both tables and graphs, and he touches upon both qualitative factors such as corporate culture and management, but also a lot of quantitative factors, which are the most important ones for in his philosophy. And I think he explains the concepts really well with examples and backed by theory. And he's really open with his mistakes. And so overall, I think it's a short and comprehensive book that we highly recommend reading.
And how does the book fit with our quality rating here at Redeye?
So I think it fits really well with the quality rating. Maybe so well that it seems like that Bjørn, the creator of the Redeye quality rating, and Oddbjørn has discussed this. But
I don't think that's the case. But
yeah, but maybe great minds think alike. The philosophy is really centered on how to evaluate management and business quality, and that is key in the Redeye quality rating as well. And it's all in all really similar to the checklist we use at Redeye and I use as an analyst and investor.
And here in the podcast, we want to provide you with timeless content, and we are careful to promote things. But we know that our guest today and many of you listeners are interested in serial acquirers. And we therefore want to mention that we will here at Redeye host such a theme event focusing on serial acquiring companies on May 18, 2022. This will be in English, and you can watch it live or on replay with a free Redeye account. You find the link in the show notes. And now we are grateful and excited to have the author of Investing in Value Creators on the show. Here comes our conversation with Oddbjørn Dybvad. Hello, Oddbjørn, and welcome to Investing by the Books podcast.
Thanks a lot. Thanks for the invite.
Where are you today?
Well, I'm sitting in Oslo and together with my colleagues here, and it's a nice sunny day.
Can you tell a bit about yourself and your firm?
Yeah. I've been managing global equities on the buy side for 15 years, and the last year we started a new asset management company here in Oslo called REQ Capital, and we launched the first global equity fund, I think, 7 months ago. It's really great to build a company where you can manage capital for others just the way you would manage your own. And over the years, I've just been fortunate to have some very inspiring mentors and colleagues along the way who has taught me a lot about investing. So looking forward to have a talk about our philosophy and strategy.
And how did this passion for investing start?
Well, I'm not one of those who bought my first stock at the age of 15. I have to admit, but I really think that my passion started as I entered the industry actually, and gained a better understanding on what really drives stock returns over the long run. And I have to admit that early in my investment journey, I made a lot of mistakes, and because I did not have a consistent framework, so to say. So I didn't have a philosophy, and I did not know what to look for in companies. And for my part, I think passion has become stronger and stronger as I've gained a bit more insight. And what I think it is important is in order to stay in this game is to fall in love with the process. And I think you need to be curious and open-minded, but at the same time have an investment philosophy. And it doesn't need to be the same kind of philosophy as we have, but it has to be something that you just strongly believe in and can guide you on the way. So So the passion for investing got stronger and stronger the more books and articles I read, and then the more interaction I had with investors and management. And even after 15 years in this business, I find it very fun to find a new investment and that ticks all the boxes in the philosophy, and that's just great. So that's been my journey.
Interesting. And last year you published your first book, Investing in Value Creators. Why did you decide to write a book?
Well, I've just realized that I do not think clearly before I put thoughts down on paper. So I like writing because when I put thoughts down on paper, I think I better understand my gaps in terms of reasoning, and I think I learn better by writing and teaching than just reading. And there have been many instances where I thought I understood a topic, and just to realize that I had a lot of gaps in terms of understanding when I tried to put it down on paper. And at the same time, I like process, and I like the idea of starting a challenging task, which writing a book clearly is, and do a little bit of work every single day and see where it takes you over a year. And that process attitude, I think, fits well with writing a book. I think so. Yeah. So it has been a great fun writing it.
And what kind of feedback have you received?
Yeah, it's good. It's a very condensed book, and the feedback is good, and then people like it, and I think it gives some perspectives that are not just theoretical, but also some practical flavor to it.
And we'll get into the book more, but can you start out with describing your investment philosophy?
Well, first of all, I would like to say that really no investment philosophy fits everyone, and investors have different experience and different time perspectives and different clients and all of that. But we believe that in investment analysis is much to do about pattern recognition, and we believe that we have seen some patterns over the years that have formed our philosophy. And our philosophy is quite simple, but I think it's effective if you aim to generate long-term good returns. And on an overall level, we invest in value creators, so companies that are able to deploy capital at very high returns over very long periods of time. And the strategies is to find these value creators. To find these value creators is to focus on three essential ingredients, that being capital allocation, decentralization, and people. And so when it comes to capital allocation, we want to invest in management teams that are outstanding investors, I would say. Investing is really a chain of trust where we give capital to management teams, and we spend a lot of time trying to find management teams that we believe are exceptional at allocating capital, and these management teams are not just strong investors. They also have a lot of freedom to allocate capital. So I do think that reinvestment is a critical component of any investment, and we need to find companies that have a lot of room to reinvest capital, both organically and also through acquisitions. So our companies often compound capital by using strong free cash flow to acquire small private companies, and they also have the ability to deploy the majority of the free cash flow in acquisitions. So in our view, identifying management teams with strong capital allocation skills is not enough on its own for a company to make it into our portfolios, but we also want these teams to operate in markets where they can deploy a great deal of capital over many decades. And finally, management teams must also have the freedom to deploy capital as they see fit. So for example, we would not invest in a company where the board has decided that, let's say, 80% of net income should be paid out as dividends to us. regardless of capital allocation opportunities. We really want managers who have the freedom to allocate capital in the best in possible way for us. And so when we find CEOs who we think are highly competent in both the human and also the human cultural aspects, but also capital allocation, we pay a lot of attention to these companies. What we have witnessed over the years is that capital allocation has major impact on the value created by the company and consequently on stock returns. And I guess most listeners have read the book by William Thorndike called The Outsiders. I would highly recommend that book. It's about capital allocation and what Thorndike explains is that the main task in capital allocation is to tap the right source of capital and deploy that capital at high returns. And so the CEO, we try to know what source of capital to tap into and how to deploy it. And I think if you got a consistent process in a company in terms of capital allocation, the results can be quite extraordinary, I would say. So finding, investing in, and sticking with these type of management teams is what I believe investing is all about.
And how important is communication?
Yeah, communication is also very important, and that really goes down to people, I would say, because the people we invest in, they tend to communicate quite differently than most management teams. They often don't provide short-term guidance. That's one thing. They often, many of them are down to earth. They are quite pragmatic. They are quite direct. They are quite open about mistakes, and I think that sends the right signals internally, and it also sends the right signals to investors. So I really like listening in to management calls and just hear how they actually communicate. I think that's very, very important. So the first part of the philosophy is really capital allocation, and the second ingredient, if you can call it that, is decentralization, and that has to do with how companies organize themselves. And I would say that practicing simplicity in this corporate world is in terms of organization is actually a very complex task, and our investment philosophy is based on the belief that a decentralized, non-bureaucratic, and how should I put it, independent governance model is the best tool to foster entrepreneurship and performance. So when we talk about decentralized business models, they consist of many underlying companies, but they are very different from, call it, traditional bureaucratic conglomerates. And over time, as companies get larger, bureaucracy tends to take its toll on a company's adaptability and accountability, and as a result, sooner or later, the entire culture and the financial engine of the company is corrupted by bureaucracy. And the opposite of that is decentralization. The very opposite of centralization, where decision making is really removed from the people taking the real economic decisions. And the result in very centralized organizations is that it's often a blame game, right? Where management and middle management blame each other, and so we try and avoid that. And so we try to find these kind of companies that embrace decentralization, and I think Mark Leonard in Constellation Software, he uses a term called high performance conglomerates. I really like that term because that's the kind of organizations we look to find. So we try to find companies that organize themselves into small teams where there is a lot of autonomy and trust, and where individual managers of the various businesses are given a great deal of autonomy for over their activities. So in essence, we strongly believe in entrepreneurship and autonomy, and I think the decentralized approach applied in the right way, unleashes really the best in all of us, and sets the stage for strong value creation. And that's why you find a lot of these type of models in our fund. And the last part, of course, in terms of our philosophies, has to do with people. It has to do with, like we just talked about, owner-operators. It has to do with people that are viewed as outsiders. They're very determined about how they want to run their business. They don't care about conventional wisdom, so to speak. And so all in all, those three actually forms the philosophy of our funds. So be it capital allocation, decentralization, and people with a high degree of ownership.
And you also mention in the book that strong and adaptive corporate cultures generate the best results, and I think you summarized that in a very good way here. Why you think culture is so important, and what's a great culture. Having read a few books on competitive advantages and moats, thought leaders such as Pat Dorsey and Bruce Greenwald don't bring up corporate culture as a moat in itself. I think Pat Dorsey mentioned something that it's a quite soft measure. What's your view on that?
Well, I really think it depends on what you define as a moat, really. I think that all aspects surrounding a company that contribute to securing a high return on capital over the long run actually can be considered a moat. So if you look at Warren Buffett, who I think introduced the term moat, I do believe that the success of Berkshire has more to do with the culture being built by Buffett and Munger over the years than the brands and the production facilities of the underlying subsidiaries. So all in all, I actually do think that corporate culture is a moat, but of course it's not static. It has to be nurtured. It has to be invested behind, just like all other type of moats.
And speaking about corporate culture and management, you mentioned many mistakes you have made in the book, and that's very enlightening for us to read about. But we were also wondering what kind of mistakes you have made when it comes to management teams and owners and investing with the wrong ones.
Yeah, I just think that learning from your mistakes is a very important part of investing, and we all make mistakes, and those investors who actually learn from their mistakes, they will be the most successful, I think. And I think that if you're not able to see the patterns in the mistakes you have made as an investor, you should just keep looking, because you will find some patterns. I really like the term confident humility. I just read a book by Adam Grant called Think Again, and he uses that term confident humility. We want to invest in management teams that are confident about what they're doing, but also have the ability to admit mistakes. And I think admitting mistakes sends the right signals, as I just said, not just to investors, but to the whole organizations that you don't cover up. So let's just say that if I were evaluating a fund manager like myself, the first and most important question I would ask him or her is what are your biggest mistakes over the years, and what have you learned from them? And the fund manager's answer to that question would be important to the evaluation of whether we should put money behind that manager or not. And I think the same goes with management teams. Ask them about mistakes and see how they respond. And my personal experience, that might not be right, but is that it's very easy to be charmed by charismatic management. In my experience, personally, I just find it best to avoid the overly charismatic managers. I might be wrong on this, but it's just my experience, and you need more than just charisma, I think. And I think it's helpful to consider how employees really could potentially feel about the CEO sitting in front of you. Because if the company is a one man or one woman show, or is the CEO able to see and acknowledge company employees? I think that's worth thinking about before investing. So I like CEOs who are down to earth, pragmatic, able to delegate a lot of responsibility, and I want to invest in companies that are run by CEOs who I think are a good role model. I think these are all, of course, non-financial aspects that are more difficult to evaluate than financial numbers. But I think these qualitative assessments are just increases the chances of good shareholder returns. So I think I'll just leave it with that.
And I mean, having read a few annual reports and listened to earnings calls and so on, it's quite rare that the management brings up mistakes. I mean, it's typically hidden, and maybe you can get it from some by talking to them directly. But why are management teams so afraid of talking about mistakes, you think?
I think there could be many reasons, but I think that if you don't start, it's very difficult to start talking about mistakes. But if you do it from the very beginning, I think you really manage expectations much better than not. And I think that most management teams are really thinking that you should always paint a rosy picture, and I just think that you have more to win in the long run as a CEO to just be very frank and open about the challenges, because then you set some expectations that you can actually achieve, and I think investors actually see this, that openness is something that you as a company will gain from.
And besides talking to management, how much do you speak with other employees or suppliers or competitors to understand management?
Yeah, since we have quite a lot of serial acquirers in our fund, and quite a lot of companies that buy a lot of small private companies, and it's quite interesting to talk to sellers. I think we have done quite a lot of that, at least in the Nordics here, where we have talked to private sellers that sell into our conglomerates, and what they their insight is quite interesting to hear, I think.
Just listening to you here and reading your book, it's clear that you really are business focused and not stock focused. But what are the key quantitative metrics you look for to determine the value creation of a business?
Well, as we all know, value creation is a function of growth and return on capital, and I think that all other quantitative measures all boil down to those two metrics, I think, and shareholder value is created when a company grows with a return on capital that exceeds the cost of capital. So no value is created in companies whose growth is zero, or in companies that are unable to generate return on capital above cost of capital. So that's just a theoretical one. But with that in mind, you can actually find what you can justify paying for different companies that are able to deploy incremental capital at various rates of return, and the runway of growth prospects are, of course, important in that regards. And what I think is striking is really how valuable growth is when return on capital is high and durability in terms of runway is long. So an increase in growth increases the value of a company with a high return on capital many, many times over. So if I were a CEO of a company with, let's say, 18% return on capital, I would actually spend all my time trying to find growth opportunities rather than trying to continue to increase profitability, because with that kind of return on capital, growth creates a lot of value. So the long answer to your question is really that exceptional companies are worth much more than you can imagine, and it all boils down to the quantitative metrics of return on capital and growth, and of course, in addition to the durability of the business model, which is perhaps more of a qualitative insight, I think.
And if you push the return on capital too high, then you will attract more competitors, I guess.
Of course.
And I think connected with this, you have a chapter on hyperbolic discounting. Can you describe what you mean by this term? Because I think it's highly connected to what you talked about now.
Well, it's interesting that you mention that. This, of course, is financial theory, but perhaps for financial nerds. But the reason I find hyperbolic discounting interesting is the fact that I actually believe the concept provides some interesting practical insights. And it's of course easier to draw this idea on a piece of paper than trying to explain it, but I can try. So the discounting of cash flows is of course normally discounted using what we call exponential discounting, right? And this discounting method is the standard method for discounting cash flows. I think we all use it since we all know it by heart from business schools. But what I find interesting is what this way of discounting cash flows actually mean, and is it really the right way to discount cash flows? So the traditional way of discounting is time insensitive, which means that you have the same relative decline in the discount factor as time goes by. So consequently, cash flows that are far in the future are not worth much under exponential discounting. So what I find interesting is that if you look at behavioral studies of humans, we do not act as traditional economic theory often claims, meaning that we are not rational, and our way of discounting as humans is time sensitive, which means that we use different discount rates depending on how long it takes to get a payoff. So let's I use an example in the book though. If you can choose between receiving $100 today and $110 in 1 year, people in experiments have a strong tendency to choose $100 today. They get the instant gratification, right? But in another example, you can choose between receiving $100 in 10 years and $110 in 11 years. And actually, behavioral studies show that in this situation, people actually tend to be willing to wait an extra year to year 11 to get the $110. So since the instant gratification is not there anyway, we act more rational, I think, and we just wait another year until year 11 instead of receiving the payout in year 10. It's so far into the future anyway. So the challenge in the second example is in which you have decided to wait 11 years is that when you approach year 10, you would rather get the instant gratification, right? In other words, people avoid waiting the closer they get to the end of the waiting period. So in the short term, people are irrational, but in the longer term, they choose the rational option. And back to hyperbolic discounting, back to the basis is really human behavior. The pattern that emerges from the way people choose as time goes on follows what is called a hyperbola, and people do not appear to use a constant discount factor as exponential discounting, and people make decisions that are much more similar to hyperbolic discounting. And what practical insight does this have? In the hyperbolic formula, the present value of short-term cash flow is lower than in the exponential model, but the present value of very long-term cash flows that we actually talked about is higher than in the exponential model. So consequently, the terminal value that we all know in hyperbolic discounting for companies with very durable, competitive long-term advantages that we have talked a lot about will be much higher than in the model that we have learned from business school. So I think in the book I use an example where I discount a long-term cash flow with the two different models, and in the hyperbolic one you get in my example 40% higher net present value, and I have to say that I'm not arguing that we all should flip our DCF models and start using hyperbolic discounting instead. The reason I find the topic interesting is that hyperbolic discounting might be one of the reasons why it's very strong companies with highly predictable cash flows long into the future are priced much higher than other companies in the stock market. And perhaps market participants in aggregate price these stocks by discounting their cash flow with a discounting mechanism that is closer to the hyperbolic discounting method than the exponential one. So yeah, I think that sums up the concept. It's perhaps for financial nerds, but it gets you into some quite interesting discussions.
No, and I think, your example really makes it easy to understand. That if you take, comparing what you can get in the next year from the 10th to 11th year. And I think, intuitively, I think I really agree with that concept.
And I urge everyone to buy the book where you can see the graphs and more visual examples. So related to this is volatility, because when you with your model, you might get a higher net present value, but the market might not see it that way and might do short-term selling, which we have seen in now recently at least. So how do you deal with this type of situations?
Well, it's a good question how you cope with volatility, and first I would say that it's deeply relaxing to buy things you never plan to sell, and the longer you extend your time horizon, the less competitive investing in stocks becomes, I think, because most of the investment world is committed to a very short time frame. So as you allude to on short-term horizons, let's say a few years, the only thing that matters to your return is changes in the sentiment or in the multiple and other short-term issues, and not many people get this kind of speculation on where the multiple is going right. So the way we cope with it is to spend almost all of our time on companies, not stocks. And it's easier to cope with volatility when you switch off your screens and focus on companies instead. And when you're confident in the companies that you have chosen, you get more relaxed in volatile environments as we have right now. And we know that the market will put the right price tag on these companies in the long run, a price tag that reflects the current value over time. So that's our way of trying to stay calm in volatile markets.
And the companies that you own, they are not dependent on raising capital and so on?
No. So many of them have a net cash position and they generate very, very good cash flow. So.
And how does the investors in your fund, how do they cope with the volatility?
We're quite fortunate in that regards, and our investors are very patient, and in spite of the market volatility that we have seen, we haven't witnessed any redemptions. But I think that our investors fully understand our philosophy and invest for the long run, and I think that's a great advantage for us as a manager of these funds.
And that's connected to what we spoke about before with, for example, managers in companies talking about mistakes and managing expectations and so on.
Yeah.
And that's it's the same thing for you, I guess.
Yeah. I think that's the same. We spend a lot of time talking about philosophy and very little time on talking about stock market, and I think that helps. And we also, quite a lot of our clients are actually founders themselves that have built companies. They know it takes time, and they know that value is created over years, not quarters.
And what would you say are your most common biases when you're investing?
Oh, that's a good one. Where to start? I guess we have the same kind of bias as everyone, like everyone else, and we work to minimize those biases. And I think one common mistake I have made several times historically is selling stocks way too early, just because of a strong share price run. And these exits have been in companies which have been strong long-term compounders, and I have very seldom been able to enter the stock again at of course a higher price point. And I'm not sure if it is a bias, so to speak, but some of my worst investments have been in companies that I have spent way too much time analyzing, and the key takeaway from these mistakes for me has been to try to find companies that are very easy to understand and where you do not need a lot of spreadsheets in order to make up your mind. So when you feel you have to start digging into the details of a company you own, my experience has many times been that I have initially bought the wrong company. So if you need to read all the notes in the back of the annual report of all the companies you own, I would argue that you do not trust the company in the first instance. So this experience has really made me much less interested in complicated business models. I like simplicity. I like to read the quarterly or the annual report and make up my mind quite quickly whether or not the company is going in the right direction or not. I've seen that too much information about the company often just leads me to decision fatigue. And in complex business models, you're not able to make up your mind about the direction of the company, and because there are too many, how should I put it, contradictory signals. And I would say that regarding the path forward, too many different signals about the path forward. So simplicity wins over complexity in investing, and so on top of mind, that is perhaps the biggest bias, and I think most investors struggle with the same kind of things.
And going a bit deeper into business models you like, we know that you have a few serial acquirers in your fund, and we have discussed this, me and Eddie, for quite a long time. That they were really in favor in 2021. Maybe now they are a bit less in favor, as they have been brought down with the whole growth sphere, so to speak. But you actually talk a lot about that investors don't need to search for businesses that are actually out of favor currently to achieve great returns. They can just frame their investments a bit differently from others. Can you expand on that a bit?
Yeah. When it comes to framing, I think I've come to the conclusion that there are really two different kinds of advantages you might have as an investor, and the first one is how you treat information or frame it, as you say, and the other is, what should I call it, a time horizon advantage over other investors. And I think that the time when you as an investor had an information advantage is more or less over long ago. And today, information about companies is so instant, and everyone gets the same kind of information all the time. But I think information treatment can, or how you frame it, can be an advantage. So the ability to filter relevant information from irrelevant information, and I think it's easier to do this filtering if you got some basic investment principles that you follow, and of course a long-term investing horizon, because then you know what to look for and what not to spend time on. And information treatment has to do with what kind of information you regard as relevant for your investment. You might think that all kind of information that is thrown at you is relevant, but of course it's not. And regarding the second one, regarding time horizon advantage, most money in the stock market is managed by professional investors, and most of them are incentivized on very short-term horizon of 1 and 2 and 3 years. And I believe this creates an opportunity for private investors who are willing to buy companies with a multi-year perspective.
Thinking about also, going in a bit deeper into serial acquirers, as you're an expert in that area, and speaking about patience, how much is a concern when prices for acquisition targets for these companies is starting to climb?
Yeah, well, I would say that first of all, there are both good and bad serial acquirers, and there are lots of serial acquirers we have looked at that we have not considered as potential investments at all. Regarding your point to acquisition prices, we haven't really at the serial acquirers that we own, we haven't really seen a a huge pickup in these multiples. Most of them buy companies somewhere between 5 and 10 times EBITDA, depending on the model. Actually, some in the UK that we own actually buy at 3 and 4 times EBITDA. But so we haven't really seen a big shift upwards in terms of private multiples, so to speak. But our interest and growing fascination for with the really high performing serial acquirers stems from our experience that these companies, they have some very good risk mitigation elements in them due to diversification, and many of them, but not all, are as I regard low risk, fundamental low risk business models. And then at the same time, I think they come with some very good elements that increase growth and potential long-term stock returns.
And this, a topic which is often discussed among, companies that acquire other companies is the topic of synergies. And how do you view these serial acquirers that talk about synergies versus not?
Yeah, well, most of the literature on M&A focuses on large M&A, right? Large M&A deals in public markets, and where synergies are important, even though they often fail to materialize. So serial acquirers on the right one, on the other hand, they do small and often private deals, and acquisitions of small private companies tend to be priced at much more favorable multiples than public companies. What we have observed is that there are no forced synergies in most of these models, and I think that's important in order to keep the entrepreneurial spirit. And so to answer your question, I think synergies are not important for our companies.
Maybe you can. I think you have discussed a lot about what characteristics you like in a business, but specifically for serial acquirers, what's the two most important factors you look at?
Yeah, if you look at it from a risk reducing point of view first, and then we can talk about the return enhancing perspective afterwards. But if you look at the first one, the risk reducing point of view, we have come into these models from the risk reducing perspective that these are business models that sell a lot of different products or services to lots of different clients in lots of different markets. So in essence, they are very diversified, and I like that. I like that they are not exposed to one single event, that one customer leaves you or one market goes sour or So those kind of single events we try and avoid. So that has led us into these models. But the other part is really the return perspective. And I think you recently had another guest on this podcast, Chris Meyer. He's a US investor and the author of The 100 Baggers. I highly recommend his book, which talks about the ingredients you need in a stock to find those that will compound capital, very strongly over the long run. And what he talked about in your podcast, is the ingredients that need to be in place. And I think many of these serial acquirers actually have many of those ingredients. If I remember the ingredients from the top of my head, it's often companies that are a bit small to medium size. They have high return on capital. They have often growth in many dimensions, being sales and the margins. They often have durability in terms of growth, and of course it helps to buy them cheap. And you might argue that there were some speculative elements last year in many of these, but of course they have come down quite a lot, and at the same time you have seen estimates coming up. So I think there is more priced at more fair prices today than they were last year.
I think that it's a really good point. When you look at the return for some of these companies for the last 15 years, they have overperformed a lot. So maybe they were too cheap before.
Yeah.
It's a...
Yeah, I think you're right on that. That if you go back 10, 15 years, people didn't really appreciate these kind of models.
So how is the geographical split in your fund?
Well, in the global, we are actually two portfolio managers. It's myself and Synnøve Jønnes. And Synnøve, she manages a Nordic portfolio, and I manage a global one. So for the global fund, we have most exposure to of course outside of the Nordic region, and we find quite a lot of interesting models in the UK, in Canada. We find quite a lot of them, and well, our experience in the US, we have some US exposure, of course, but our experience is that many of these models often are in the hands of private equity, and so the geographical split is mostly outside of the Nordics.
And if we go into more of the portfolio management and the construction, a common mistake is to hold on to losers, and we touched upon some of your mistakes before. And you said that you want to buy them back, like if they deteriorate, you sell them, and then you want to buy them back when they improve in the fundamentals. So that's the key, is to understand if they are actually improving in the short run. So, and many investors are mixing up the sinking stock price with the bad fundamentals. So how do you go about figuring this out and not get swayed by Mr. Market?
Yeah. So the key lessons for my part has been to be very hesitant to sell stocks in companies that are working perfectly. It has to be more than just the pricing of the share, because sometimes the stocks of our companies, they run ahead of the underlying performance of the companies, and the lesson for my part is really not to let the temporary high price of the stock scare me out of the company. So it really boils down to I more or less arrived at three reasons to sell a stock, and the first one is quite simple. It's that we made a mistake in buying the company in the first instance. So the company is not as strong as you thought. We could have underestimated cyclicality in the industry or the company, and just basically done a mistake, and should take the consequence of that. And the second reason to sell a stock is that you don't trust management anymore, and management just starts to convey a new message, or a message that you do not understand. You do not like the language that they use, and that's also a big red flag in my eyes. I have made several misjudgments about management over the years, and through these mistakes, I've arrived at some principles regarding management and that we just talked about. And the third reason to sell a stock is, of course, the pricing of the share, but which is far beyond what you think is rational. And I think this is the most difficult reason to sell, and therefore I'm very, very reluctant to sell based on pricing of the share alone. And there are always very good reasons why a stock trades at a high multiple.
And I guess we could add to that list, if you find something better, you would buy that, of course.
Yeah, we try to do that.
So you mentioned in the book that the largest holdings in one's portfolio shall not be those that offer the highest return, but instead the ones with low risk and above average returns. Can you expand a little bit on this?
Well, my experience is that, my personal experience is that the largest position in the fund, in the portfolio, should have the least fundamental risk to them, not necessarily the highest return potential. So the largest positions in your, I think in your portfolio should work to decrease the risk of the portfolio rather to increase the total risk. And the largest holdings, in my view, should have the lowest likelihood of a permanent capital loss. And of course, every investor has different mindset in terms of position sizing, and you should find your own preference depending on your risk tolerance. And the best way to learn how to size positions is to learn by experience. I think there's no right or wrong diversification, even though financial theory says that most of these unsystematic risk is diversified when you reach 20-25 stocks. And I think you just have to work to find your own style and your own risk tolerance.
I have a bit of a philosophical question maybe, but I really like that your book is, one part is very quantitative and it's very, in a way, theoretical, even though you link it to behavioral aspects, for example, the hyperbolic discounting. And then you have this other part which is very qualitative, focused on culture and management and so on. So how many percentage of investing would you say is science and how many percentage is art?
That's a good question. How should I answer that? My experience has been from the quantitative side over to the more qualitative aspects. So when I started investing, I thought you could find the answers in the spreadsheets. So of course, we have to look at financial history and stuff like that. But I've just become more and more interested in qualitative aspects, and what I talked about early on. How companies organize themselves to foster entrepreneurial energy. I've become much more interested in management, the message and the signals that management sends to investors and of course employees. And on the quantitative part, it has to do with capital allocation that we also talked about. So in summary, I think that my investment journey has moved, I wouldn't say from, but over to the more qualitative part, because I find that to be the most important ones when you're investing for the long run.
And we know that you're a big reader as us, and we wonder if you have any recommendations of books that you want to mention that have shaped your career and life.
Yeah, I think I think The Outsiders that I mentioned by William Thorndike is just great regarding capital allocation and on the philosophical front, on living better lives. That's a difficult one, but I think that Dale Carnegie, and his books, especially the one How to Influence and Influence People, is a great one. The content of that book is of course very good and better than the title, I would say. And currently I'm reading Think Again by Adam Grant, who is an organizational psychologist, and he's got some interesting perspectives on rethinking, and I really like from his book the term confident humility. That's really something we try to find in management teams.
And is there any book that you would like to exist?
Oh, that's a good one. Yeah,
and not write yourself, I guess.
Yeah. Okay. It would be very interesting to. There are tons of books by Warren Buffett out there, but it would be very interesting to read a book that I haven't seen exist by written on Mark Leonard in Constellation Software, Canadian software conglomerate. That I think that's just as interesting as the story of Berkshire. So looking forward to someone writing that one.
And do you want to write more yourself?
Yeah, of course I do. As I said in the beginning, we like process, and writing a little bit every day, and suddenly you have a book there, and so we try to continue to write and to clarify our thoughts.
Thank you so much, Oddbjørn, for a very thoughtful conversation, and it was great to hear about your insights and more about your book, Investing in Value Creators, which we, of course, highly recommend. Do you have something more you want to add before we finish up?
No, just thanks a lot for very good questions, and thanks for getting in touch, and enjoy the conversation.
Great. And where can our audience follow you? Well,
I'm on LinkedIn, of course, and I'm not very active on Twitter, but I have an account there and not very active. So, but we on our homepage actually we put out some articles now and then, and of course our half-year reports or yearly and half-year reports are quite extensive. So they can find more information on the webpage reqcapital.no.
Perfect. We will put that in the show notes as well. Thank you so much, Oddbjørn.
Thanks a lot. Thank you.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.